Hey, what's up, Skyview? It's Christos, and it's April 25th, 2017, and we're just looking to add a new trade to our portfolio. So I've got my watch lists up here, and I was just kind of taking a quick look. And because a lot of these stocks have earnings, I guess I kind of defaulted my eyes to the ETF watch list here. And FXC is the top of the board, but we already have a position on in FXC. Even though it is a May position, we could technically put on a June position. It would be like just moving our risk or spreading out our risk between the front month May and the back month June. But I think it's kind of best to maybe not mix yourself up or confuse yourself with too many positions in one underlying, especially early on in your journey. So let's just forget about FXE and just moving on to the next one down is XRT. So we can just take a look at XRT. We obviously know that it does not have any earnings or anything like that because it is an ETF, and ETFs do not have earnings announcements. So there's nothing like that stopping it. We can see this large contraction in volatility recently, but that happened across the whole market, all the underlyings, and it was just because of the French election news over the weekend. So once that binary event fizzled down, volatility pretty much contracted across the board in every underlying in the market for the most part. Other than that, we have the 12-month IVR at 37, and that's not bad at all. To me, it kind of seems like 25 is the new 50 these days in these historically low volatility environments that we've been in. So 37 is pretty good, and it's, like I said, also one of the top ones on the list. So why don't we just go ahead and go to the Analyze tab and see what we're working with, what the spread widths look like, if they're looking liquid or anything like that. So XRT, and there's only 24 days left in May. After 30 days, we start to get a little cautious under that 30-day mark. So we'll push it out and we'll go to June with 52 days left and approaching our sweet spot of 45 days. We want to start putting on positions and kind of bulking up into that 45-day number. So I just like to go right to the at the monies just to kind of see what the spread is between the two. And okay, so 78 and 85 about 7 cents, 169, 179 about 10 cents, and that seems pretty consistent across most of these, around 10 cents of a spread or so. So not terrible, a $42, $43 stock. So ideally, we'd want even tighter spreads, but for me, anything within 10 cents is kind of good enough, at least from what I feel and from my experience of just trading all these underlyings. And if there's a lot of open interest and volume, we'll be able to get filled near the mid price. So when I see markets like this, I kind of default to an iron fly just because there's not a lot of meat on all these bones, right? There's just due to the nature of the lower priced underlying, the option prices aren't very big, right? So it's like it drops off under $1 once you hit that first, out of the money option pretty much. So because of that, it's kind of tough to construct an iron condor. So I like to do iron flies. And I like to make them pretty much as neutral as possible. Sometimes I have a bullish or bearish assumption, and if you want, you can look at the chart, and whatever it is that you look at, whatever it wants to keep you engaged, go ahead. Maybe you think it's going up towards 44, maybe you think it's going down towards 42, or maybe you think it's just going to stay around here and want to do a neutral trade at 43. More often than not, that's what I do. I just pick a neutral trade, but there are times when I do skew them slightly to the bullish side or to the bearish side. It's really just your own personal preference, and does it make a huge difference in the grand scheme of things after a 10-year period? Probably not, right? Probably not. So I'm just going to stick to that 43, try to wrap my iron fly around 43, pretty much right at the money. So I'll go ahead and I'll click on the bid here. and then I'll click control or hold control and also click on the bid over here. So now I am just short the 43 call and put, and that is called a straddle. So this is naked premium, but I don't want naked premium, right? I want a defined risk trade. So we just have to spread off our risk. And I usually like to go 3, 4, or 5 points wide. Just kind of taking a look at these. Going 4 points wide takes us to the 12 delta on the put side. That's pretty good. Let's see what 4 points wide on the call side would take us to. That would be that 47, and at the 10 delta. So I feel pretty comfortable with my protection around the 10 delta. That's kind of how it usually is, even for my iron flies. I usually find that I am buying protection around that 10 delta, sometimes the 15 delta even. So let's just see what the credit would look like. Kind of a wide spread here just because of the nature of how low the option prices are, but because we're getting filled on the whole spread together as one, it's usually not as bad as those out of the money option spreads would show. So let's just go ahead and go 4 points wide on the call side, and then 4 points wide on the put side. Again, I'm just holding down the control key and then clicking on the ask, and then it just kind of auto populates it in down here. So here is our iron fly. Now the platform defaults to an iron condor. It doesn't recognize the iron butterfly for whatever reason, but that's okay. We know what it is just because we are short the same strike call as strike put. So we know that that is an iron fly. Collecting a credit of over $2 is what I usually like to do for iron flies, and I usually collect around 50% of the spread width. So we have a $4 wide spread here, and we're collecting around $2, which is just around 50%. So it looks like all of my personal criteria are kind of matching up on this. And remember, it's not about constructing that one perfect trade. It's simply about constructing lots of trades, generating lots of occurrences, shorting premium, liquid underlyings, and keeping a management style that also allows us to put the odds in our favor even more, right? So just doing things that put the odds in our favor even more, and just rinse and repeating that every month. So we can just take a look at the risk profile if we'd like, and we can see what our max loss is, about $196 on each side if we are filled here at 204, which would give us a $204 max profit. So I'm a fan of this. The other thing would be if you want a little bit less risk, you go 3 points wide. If you want a little bit more risk, you go 5 points wide. Just kind of playing around with what is personally best for you. We can just look on the chart. We know that we're short the 43 call and put, and we're collecting around $2. So our break even is going to be $2 above and $2 below that 43 strike call and put that we are short. So let's just go ahead and put some approximate break even points on the chart. $2 up from 43 would be around this 45 area. So let's see if I have my little price tool out. Nope, it's on the trend line. So we'll go to 45. We'll put a line in there and just edit the properties quickly on it. Hopefully quickly at least. And we are going to put that to 45. And then $2 below the 43 is around 41, right? So we'll throw in a line there and just make it exact. And sorry for the slamming on the keyboards. I know that doesn't sound too great in the video. But anyways, this would be our break-even point. And then we did a $4 wide iron fly. So on the upside, our max loss is anywhere above 47. So we can put that in there. And we'll throw a line in here at around 47. Some more slamming on the keyboard. Sorry about that. And then 4 points wide from 43 on the downside brings us down here to 39. So we'll throw in a line there. 39. Let's make it a little bit different just to differentiate ourselves from our break-even range and our max profit or max loss areas as well. So that would be around what we're looking at for this trade. Anywhere between here, we will not lose a dime, and the only way we lose our max loss is below that and above this. Now, it's very important to trade small, because if we trade small and we are getting tested and we might have a max loss, well, that's just the way the cookie crumbles for that trade. It's not going to close our doors for business or anything like that. And you know, we don't recommend adjusting a lot of our defined risk trades. It just doesn't make sense to us for a variety of reasons, from our research to our experience to the extra commissions to just building bad habits in general. It just doesn't make much sense to adjust most of our defined risk trades. And I also want to mention that people act like adjustments in rolling trades is like a sure thing. It's not. What rolling a trade does, or adjusting a trade, is it essentially locks in your loss for the month, and then you just initiate another trade in the next month, and that trade actually has a lower probability of profit than the original trade that you initiated. So what you're doing is locking in a loss and then initiating another trade with a lower probability of profit because it's much more directional. It's usually not a neutral trade because the trade has gotten away from you, and then you want it to go back directionally to your original premise. And at the end of the day, that's just a directional bet. It's a low probability bet, and it's just locking in your loss and initiating another trade that may or may not work out. So I just don't want anyone to get the idea that, oh, if we adjust trades or if we roll them, it's a sure thing that we're going to make our money back, because it's not. And what I found personally with these defined risk spreads is that when I was trying to adjust and roll everything every time, you know, something got a little bit out of whack, my deltas or my emotions or whatever have you, it just led to a lot of over trading. It led to a lot of commissions, and it didn't really lead to any more opportunity. So I really take a much simpler approach now, and Adam and Eli do as well. And we simply let these probabilities play out. We are patient with our losers, and when we have our winners, we take them. It really is that simple when it comes down to it. It's just the fact that when you're new to this concept and approach, it's very difficult to build faith in something so simple until you really have the experience and you watch it play out for several months, a year plus, whatever it might be. Anyways, we haven't even routed this order, but this is what it would look like. So why don't we go back to our Analyze tab. We're still hovering around that 203 credit, and we will give this a shot here. So I'll right click, and then I click Confirm and Send. And I always like to just take a look at what I'm working with in the spread. Kind of wide between the NAT and the mid price, but if we have a lot of volume and open interest, we'll get filled right at this mid price. So let's give it a shot. Going at 203 here. It's in June on contract. Everything looks good. And there you go. So that's how you know there's a lot of volume and open interest. You're filled exactly at the mid price. That's always good. So got another position in our portfolio, XRT. You can see it's actually been good to us yield to date. We made $193 in XRT this year so far. So, you know, when something's working, you just kind of keep going back to the well and rinse and repeat. And that's pretty much the name of the game. So go back to the chart. There it is again, guys. XRT, our break evens are pretty much around this range from 41 to 45. And our max loss is anything above 47 or anything below 39. So XRT, it's an iron fly, which means we're going to look to manage this actually at around 25% of our max profit. So 25% of our $203 max profit would be around $50, right? So we're looking to take $40, $50 out of this trade, 25%. And the reason why we manage these iron flies a little bit quicker is just because of how much of a percent of the spread width we are collecting. We are collecting around 50% of the spread width. That in turn makes it a lower probability of profit than, say, a traditional iron condor or some of our other trades. And because we have a lower probability of profit, we simply want to manage more aggressively, right? And what that does is just greatly increases our odds of profiting on this trade. And that's all we do. We learn how to create winners. We put the odds in our favor so we can create winners, and we take on risk and we force the market to beat us, because that is the name of the game. So that's it, guys. I hope you learned something from this. Thank you for listening, and until the next video, take care.